Welcome back, focused learners, to another explainer. Today we're tackling a massive milestone for your exams. We're looking squarely at ACCA Financial Management, specifically Syllabus Area C2. We're going to conquer corporate working capital ratios and credit management. If you want to understand how a business actually survives day to day, you are in the exact right place. Grab your notes, get comfortable, and let's master this together.
So let's dive right into this with a question that honestly might seem totally counterintuitive. Why on earth do profitable companies still go bankrupt? I mean, you look at a brilliant income statement, revenue is way up, margins look absolutely great, but then suddenly the doors are closed. Why? Because a business's true lifeline is its cash flow, not just its paper profits. You can be wildly profitable on an accrual accounting basis, but if all your cash is completely tied up in inventory that hasn't sold or customers who just haven't paid, you literally cannot pay your own employees. Working capital management is the art of keeping that cash flowing.
Here is our game plan for today. We'll be hitting the cash operating cycle, those vital working capital ratios, managing accounts receivable, the classic factoring versus invoice discounting debate, and finally, strategic accounts payable. Let's get to it.
Section 1. The cash operating cycle. Literally the heartbeat of any business operation.
Now, this cycle basically measures the time between paying cash out for your materials and actually getting cash back from your customers. And what's really fascinating here is the stark contrast between different business models. Take a manufacturing firm, for instance. Their cycle is inherently longer, way more complex, because it equals inventory days, and yeah, that includes raw materials and work in progress, plus receivable days minus payable days. But then you look at a retailer, and their formula is just so much simpler. They skip raw materials entirely, so their cycle is just finished goods inventory days, plus receivable days minus payable days. Grasping these specific components, that is absolutely foundational to figuring out a company's true liquidity needs.
Moving on to Section 2, Vital Working Capital Ratios. Think of this as your corporate dashboard.
Let's walk through this vital dashboard. You've got the current ratio, which measures general liquidity, just current assets divided by current liabilities. Super straightforward. But then, the quick ratio, or acid test, actually strips out inventory from those assets to show your immediate, right-now survival capacity. Then we shift gears to efficiency metrics. Inventory turnover compares cost of sales to average inventory, basically telling us how fast goods are flying off the shelves. The average collection period tracks receivables against daily sales to see just how long customers are dragging their feet to pay, while the average payable period tracks the exact same thing, but for your suppliers. And finally, sales revenue divided by net working capital shows how efficiently you're generating that top-line revenue. For the exam, you've absolutely got to know how to calculate these, but honestly, the crucial point is knowing exactly what story they're telling about the company's operational health.
Section 3, Managing Accounts Receivable. Or, as I like to call it, speeding up the inflow.
This is where we play offense. You've made the sale, awesome, but how do you safely get the actual cash? Well, it unfolds in 3 logical steps. Step 1, assess creditworthiness. Before you even think about extending credit to a new customer, you have to thoroughly evaluate them. Look at trade references, bank references, credit reports, the whole shebang. Step 2 is establishing credit limits. You don't just hand a blank check to a new client, right? You set a hard cap based on their assessed risk to limit your maximum possible exposure. And then step 3, implement debt collection methods. When that invoice is due, what's the game plan? It usually starts with statements, moves to polite reminder letters, maybe some phone calls, and eventually, if it really comes down to it, legal action. It's basically a carefully escalated narrative of risk mitigation.
But hey, what happens when that customer is sitting halfway across the globe? Managing foreign receivables amplifies these risks massively. Suddenly, you aren't just sweating over whether they'll pay, but what the currency will actually be worth when they finally do pay, thanks to currency fluctuations. Plus, you're dealing with completely different legal systems if you have to chase down a bad debt. Extended transit times mean your cash is tied up for way longer, and let's be real, international credit checks are notoriously difficult and expensive to get your hands on.
So, one really powerful technique to speed up that inflow, whether we're talking domestic or international, is offering an early settlement discount. Think about offering a 2% discount if they pay the invoice in 10 days instead of 30. Sounds great, but you have to mathematically evaluate this. You are literally sacrificing a percentage of your hard-earned revenue. As a financial manager, you have to calculate the effective annualized cost of this discount and put it right up against your company's own cost of capital. If the cost of offering that discount is actually lower than your overdraft rate, well, then it's a brilliant move.
All right, on to Section 4, Factoring versus Invoice Discounting, the big showdown.
Sometimes, even with those discounts, you need cash right now. And the tension between these two major corporate tools is pretty stark.
If you go with a factor, you are essentially outsourcing your entire sales ledger. The factor advances you cash, usually around 80% of the invoice value, and then they go out and chase the customer for payment. It's highly visible to your customers, and you definitely suffer a potential loss of control over those relationships. On the flip side, we have invoice discounting, which is strictly a financial arrangement. You borrow against your invoices, sure, but you keep the debt collection completely in-house. It stays totally confidential from your customers, which lets you maintain absolute control over the relationship. For your exam, emphasizing this specific difference in control, visibility, and cost is an absolute must.
Which brings us to Section 5, Strategic Accounts Payable. This is all about slowing down the outflow.
We've spent all this time looking at getting cash in, so let's flip to the defensive side of things. The financial manager faces a classic dilemma here. On one hand, you have trade credit maximization. Your supplier's money is essentially free short-term financing. If they give you 30 days to pay, taking all 30 of those days means you can use that cash somewhere else in your business. But on the other hand, those same suppliers might offer you early settlement discounts. So the strategic tension really boils down to this. Do you stretch out that free financing, or do you pay early to secure a solid reduction in your purchasing costs?
This all builds into a critical financial evaluation where you just have to run the numbers. You need to calculate the annualized cost of declining the supplier's discount. Let's say a supplier offers you 2% to pay 20 days early. The annualized return on that 2% is often surprisingly high. We're talking sometimes over 30 or 40%. If that return happens to be higher than what it costs your company to borrow from the bank, well, mathematically, you should absolutely borrow from the bank, pay the supplier early, and snatch up that discount. It's all about comparing the cost of the lost discount against your corporate cost of short-term funding.
As we wrap up this explainer, I want to leave you with a real-world scenario to really test your mastery of Syllabus Area C2. Picture a struggling economy. Cash is incredibly tight everywhere. Do you prioritize aggressive debt collection to ensure your own survival, or do you lean towards preserving those long-term client relationships by offering them some flexibility? It is the ultimate high-stakes balancing act of working capital management. Think really carefully about how the formulas and ratios we went over today would guide your decision in that exact moment. Keep studying hard, stay focused, and I will catch you in the next explainer.